Are we recording this?
Recording and we are live. So this is Anthony Mento here, along with my friend Rick Blazer. Good afternoon to everyone on the East Coast, and good morning to the rest of the country. We appreciate you attending with us this morning. We're covering. We had some fun with this one. Whole life seems to be the in vogue product of choice at the moment, and as Rick said, he has a lot of agents that sell whole life, and Rick is with New York Life, and extremely talented individual in our industry, heads up the advanced market team, and he's our go-to when it comes to case design. And he and I talk all the time, and the agents who sell whole life can look clients in the eyes and say that they've never had to apologize for the products that they've sold. So today what we'd like to do is I've created a question set for Rick. We're going to get some intel from a high-ranking administration individual at New York Life, and a perspective on his view of the whole life insurance industry. And then what I'd like to do is share some planning concepts that we've been using with our very best and brightest whole life minded agents. So this should be fun. We're going to get some commentary from Rick. I have some visuals in between each slide and each question set, and then we'll open it up for questions at the end. So here's our panel. Here are our panelists. Our agenda. The presentation is called "The Many Faces of Whole Life." There are 7 or 8 faces that we're going to have some fun with today that describe whole life, from everything from the buying and selling opportunity to private equity jumping into the space, bond replacement, buffer assets, leverage tools, and then we're going to get into some estate planning concepts. So without further ado, I'm going to dive right in, and I'm going to just toss a few questions over to Rick. So Rick, face one, as you can see in the top right corner here, is a big smile on that particular emoji. So and I would equate this to this smile to both the consumer and the agent. Give us some idea on why we feel as though there's a buying opportunity in the next 2 to 5 months as it pertains to whole life type products.
Well, Anthony, thank you for allowing me on the call today. I think that there's a couple of things. One is that all the products, as you may know, for whole life have to be repriced before the end of the year. And because of the new 7702 rules that came out, so all these products, all the whole life products we have now, are currently going to be repriced before the end of the year. And the reprice is necessary because the reserve rate, which is effectively the guarantee rate under the product from a gross perspective, is going to go down. So when you look at the current products we have today, they're priced at a 4% guarantee rate underneath the product itself from a reserve. We call it the reserve rate under the product at 4%. The new rules allow for those reserve rates to drop from anywhere from 2% to 3.75%. So and those are the rates used to effectively endow the contract. So if you endow a contract at 4% versus endowing a contract at 2 or 3.75%, you're going to end up with a less expensive product today, I think. And we can talk a little bit later in the presentation about how the New York Life product is built. But right now, the way the product works best is really designed to be an all-base design, which is great because it's great for the client and it's also great for the producer as well.
Rick, we have a slide up on the screen, and taking cost of insurance out of the mix and taking dividends out of the mix. It's just a very simplistic example on how a product or what a premium requirement looks like in a guaranteed product at different assumptions, right? So what everyone forgets is that whole life actually has 4 contractual guarantees, right? Everyone thinks of the big 3, which are the premium, the cash, and the death benefit. But the 4th guarantee is the endowment. Whole life contracts must contractually endow. So in order for your cash to equal your death benefit, it's just a present value calculation based on certain assumptions. So if you look at the left side of this analysis, at a 4% assumption, a $1 million endowment was going to require $6,200, right? Again, taking all the cost of insurance out of the equation here, but just as an example and a model, and what we're looking at using different assumptions. You jump over to the right side of the analysis at a 2% assumption, And in order to endow that same $1 million where the cash value equals the death benefit at maturity, which is our contractual guarantee, that $6,200 premium goes up to $11,500. Big difference.
Yeah, I think it's a huge difference. And I think where you may be going next is how does that affect the compensation regarding these products as well? So when you look at this and you say, okay, clearly the price has to go up to endow the price has to go up to endow that contract. So the premium is going to be higher, but the target is going to basically be the same because the death benefit is the same. So it's a higher premium, but it's going to be a lower target relative to the total amount of premium you're asking the client for in those cases. So I think you have a situation where it's increased cost and you're not going to get paid as much to sell it versus today's world, especially in the limited pay space where there's a target. On the full pay whole life pay to 100, generally the whole premium is going to be commissionable in that space.
Yeah, and we're seeing more and more sales in the limited pay scenario, Rick. New York Life being a little bit unique to the marketplace, that can contractually pay up a base contract in year 5 at the right age.
Yeah, I can only speak for my business in the Northeast. As you know, I cover the Northeast, and we're seeing probably 90% of our business be the limited pay whole life product. That seems to be what people want, either the 10 pays, 5 pays, 7 pays, contractually guaranteed.
Yeah. So I'm going to jump in, and we're going to come back to that, Rick, in that limited pay. But I want to just introduce, phase number 2, right? Where I solemnly swear, you see in the top right corner, right? I promise to do the right thing. And that becomes problematic in the world of promises when private equity is looking to jump into not just the life insurance industry, but specifically whole life and mutual companies, and then subsequently demutualizing them, right? We're seeing Ohio National, we're seeing Columbian Financial Group, seeing Constellation Insurance Holdings jumping in and scooping up some of these companies. And I don't think there's any secret. I mean, the private equity firms are looking for a cash grab. They want access to capital and they want to do their thing. And what better capital intensive entity to acquire than a life insurance company or a struggling life insurance company due to low interest rates or poor management? I think we're set up for long-term disappointment. So the phase number 2 is the private equity in the cookie jar. Our suggestion and our strategy has been to diversify away from those particular carriers. I'm not saying to completely replace. You certainly want to stick around for any type of compensation due to the demutualization, but I certainly wouldn't continue to drive large sums of new money into these contracts because you just don't know how these private equity firms are looking at the long-term view. And I'm showing you here an example of a whole life contract that is now under the guidance and ownership of a demutualized private equity firm, has 7 years left on a 10-pay structure in columns 3 through 5. So this is your in-force under current assumptions. I'm taking that same exact contract and I'm exercising the reduced paid up option in columns 6, 7, 8. So you see a $5 million death benefit being reduced to 1.8. And what we're suggesting here is to redeploy that $100,000 commitment over the next 7 years to a company that is in a little bit of a better standing, that's in its mutual status and treating customers a little bit better for long-term performance. And you can see that combining the strategy provides a better result in columns 15, 16, and 17. And Rick, I know you've seen an influx of business from agents associated with companies who are going through a transition. And, we appreciate the financial strength and the commitment at New York Life to our policyholders.
Yeah, I think it's a flight to quality. When we see these things happen in the industry, people get concerned and then there ends up being a flight to quality. And I think our ratings speak for themselves with respect to New York Life and the other top quality mutuals too that you may represent. So I mean, it's not exclusive to New York Life. I think there's just a flight to quality when you see the industry start to get a little bit rattled with things like that.
Phase number 3, this phase kind of leaves the pondering to start looking at whole life as a fixed income replacement. Our wealth management clients have really started to study the benefit of replacing bonds with whole life insurance. And Yeah, historically, up until the last couple of years, we were getting somewhere around the same exact outcome. And as of late, particularly the last two years, having whole life in lieu of a bond portfolio actually slightly outperforms the fixed income solution. And it's also noted that the cash value grows more steadily than fixed income, which is certainly subject to the ups and downs of the market. And then when you add the tax deferred treatment of cash value, death benefit, um, whole life becomes a clear cut winner. You know, and I know you see a lot of this, Rick. Can you provide some commentary around this concept?
Yeah, I think what we're seeing out there is that New York Life, when you look at our portfolio, we're about 75% in the bond portfolio. In our overall portfolio, it's about 75% bonds, 95% investment grade bonds in our portfolio. So clearly, there's a correlation between the performance in the whole life contracts and a bond portfolio. But I think what you're starting to see is when you look at a whole life from an illustrative perspective, when you think of a dividend with whole life, there's the investment component, there's mortality and expense assumptions included in there. And then what you see from a practical perspective is that the way carriers have been able to navigate the interest rate environment right now is by supplementing that dividend with earnings and investments from their other pieces of business that we have. So effectively, you're getting a bond account plus with respect to a whole life contract. And that's helping to create that kind of arbitrage, if you want to call it that, between what you might see in a bond account versus a whole life policy. But New York Life's done some studies on this. A couple of years ago, we did one with a major financial reporting group, and they looked at a policy from 1982 all the way up to 2017. And basically, you end up with a very similar return, less volatility, and you get a death benefit to boot with the whole life product. So people are looking at that and saying, hey, you know what? This is a great place to put my money. It always goes up. So I put the money inside the whole life contract, and it ends up being a great place for your money to sit, particularly from a tax deferral perspective. And then ultimately, if you're not going to use it, ending up being for death benefit, or if you're going to use it, the money comes out very efficiently from a income perspective.
We'll get into other uses in the upcoming slides, Rick, when I share a couple new faces.
Mm-hmm.
Here's a quick analysis here, a quick study on a participating whole life contract. So in the top left, I take the Vanguard Total Bond Market Index Fund, and I look at the year-to-date return at 65 basis points. A 5-year average return at 2.13%. Over the last 34 years, 30 years have gone up, but the misconception of that bonds can't go down is actually quite misleading, because 4 of the last 34 years, the bond returns have actually gone down. What we're seeing is the very best 3-year return at 8.6, which is quite remarkable. We think those days are behind us, and the worst 3-year total return is 1.21. So if I look at a participating 7-pay whole life contract where I drive cumulatively $500,000 that I repurposed from fixed income to whole life, contractually guaranteed break even by year 7, projected break even by year 6, and you see that I can surpass by year 8 that 5-year average return of 2.13 significantly. Now, the IRR on cash is really strong in these particular in a limited pay whole life contract. So it kind of speaks to the concept that we just described. Face number 4, what you'll see here is this particular face is really rocking out because they're living a much better lifestyle, right? If you have whole life in your portfolio, you can use it as what's referred to as a buffer asset. And the concept has really grown in popularity. Dr. Wade Pfau heads the American College, is actually teaching designation curriculum around this. This is one of the strategies in the retirement income certification program. And at the end of the day, your distribution rate is what matters in retirement. And if you have all investments, in theory, your distribution rate, right, which we all have come to know as the 4% rule, is no longer the 4% rule. We're likely in a 2 to 3.5% rule. So in order to protect your all investment portfolio against sequence of returns, taxes, the ups and downs of the market and volatility, you can only distribute anywhere between 2 and 3.5% of your total asset portfolio. So, a $10 million portfolio, you can typically draw down 3% of that, and you will likely, in all probability, not outlive your portfolio. Now, you couple that with some cash value life insurance as a buffer where you can buffer, quote unquote, buffer against down markets and pull from your cash value life insurance in the year following a down market and give your equities and investment portfolio a chance to recover. That gives you the permission slip to now distribute between 5 and 7% of your total assets. So you're living better, hence the headphones and the rock star type emoji in the top right corner. So Rick, you would give us a little bit of color on how you view the concept of buffering in addition to what I just explained?
Yeah, I mean, I think you hit the nail on the head. But for the most part, I mean, the idea is you don't want to take from an asset that's been beat up and further beat it up by taking distributions from it. So what better asset to have than one that always goes up? So when you look at a portfolio, it's nice to take from an asset that's thriving rather than one that's getting beat up. So when you look at your investments, it really doesn't make sense to take money out of those beat up investments. In fact, I looked at some numbers prior to this presentation. The S&P in 2008 was down 38% in 2008, based on what I could find. And what's interesting is that analysis we did over the life of a life insurance policy from basically 82 to 2017, I think when it ended. I checked what the return on that policy was, and the return in 2008 on the life insurance policy was 5.25%. So in that particular year, you got a situation where the S&P was down 38%. The following year went up by 25%. So if you took money out of that S&P account when it was down 38%, you wouldn't have participated in that 28% upside. So the idea would have been take money from the life insurance policy in that subsequent year, let the money stay in the market, recover, and you're going to be better off than you would be had you keep taking money out after a down market. So yeah, it just makes common sense, really.
Well said, Rick. And it's just a simple reposition. With the use of PDA accounts and limited pay contracts, you can very easily take $1 million portfolio and carve that up between cash value life insurance and equity assets. And you can see in the example that we're using here, on $1 million portfolio with a distribution rate of 3.5% provides you $35,000 of living, versus having $750 in equities and $250 in cash value life insurance gives you the permission to distribute at 6% and $45,000 of living, plus a remainder death benefit to the family, as well as more steady growth. So, as you drive down the distribution rates, the 4% rule was created with an assumption that equities would do 10% and bonds would do 5%. Well, that assumption is, long gone, right? I don't think, if you can pull off 10% equity in the 10 years going forward from today and 5% in bonds, I mean, you've done a remarkable job. I just don't think that exists. So that impacts the distribution rate. We think personally the rate is somewhere between 2.7 and 3% in reality. So buffering assets are really key. And there's only 3 types of buffer assets. There's cash value whole life, there's straight cash, which you're not getting very much growth on at all, or reverse mortgages. And that's the American college curriculum, not mine. So, and we're looking at just different strategies. And if you have 4 years of buffer, which means if your retirement goal is $100,000 a year and you have $400,000 of cash value life insurance, that gives you the permission slip to take a 6% distribution rate. And you just don't need the amount of assets you do where if you were withdrawing at a much lower distribution rate using the Monte Carlo withdrawal rate. Moving on to face number 5, Rick, and this particular emoji is showing tears of joy, right? This is a really good feeling when you connect and your entrepreneurial spirit comes out and you hit the home run. So what we found lately is that the banking community loves whole life insurance, and they, more than whole life insurance, they love collateral. And if you're providing secure forms of collateral, they're going to give you preferential borrowing rates. So we've seen bank after bank enter the life insurance space in introducing collateral and lending type programs that center around whole life, right? Whole life line of credit is particularly a title and a concept used by several banks who actually attend NALBA and MDRT and are actually looking for this business. Rick, give us some color on the entrepreneurial uses of these whole life line of credit facilities and having whole life in the portfolio, being able to go out and secure this type of lending.
Well, yeah. So think about this. Typically, the whole life products are issued by some of the strongest insurance companies out there. So if you got a whole life product, it's more than likely issued by a very strong carrier. The banks love the credit ratings of those carriers and the financials associated with those. But we're in an interesting environment right now where the Moody's Corporate Bond Index that basically ties in the loan rates for the life insurance policies is below the floor on a lot of these contracts. So I know New York Life because I work there. So the floor rate on our products is 5%. The Moody's corporate bond rate is below 5. So what's ended up happening is that the banks have figured out that what they can do is they can offer clients credit lines that have an interest rate that's lower than the floor rate on the life insurance policies. So it's opening up the door to third-party financing, kind of post-issue financing on these products, where let's say you had $500,000 of value in that life insurance contract, you may be able to get out 90% of that at a lower rate than the 5% loan rate that's in the New York Life contract. And so it creates a huge opportunity for arbitrage between the performance in the contract and what you can borrow at. And I see this all the time, particularly in the high net worth space with real estate investors. So what they'll do is they'll put money in their life insurance policy, and then when a deal shows up that they want to get involved in, they're going to take money out of their credit line, go invest in that piece of real estate, whatever it's going to be, and they're getting a very low rate relative to what the performance in the contract is. And at some point in time, they'll turn around and pay that back. So it's kind of this idea of post-issue financing, which is really driving this activity. And I'd say keep it in mind for a lot of things. One is, I think also we talked a little bit about the 7702 changes. And what people sometimes don't realize is those 7702 changes, the interest rates in the products, so that 4% rate we talked about earlier, that's where the floor rate on the life insurance loan rates are derived from. So if you have a carrier that has a 5% loan rate, then their guarantee rate in their product is 4. If they drop the guarantee rate down to, let's say, to 2, then the rate in the product is probably going to be 3 or 3.25 from a loan rate perspective. So it may illustrate really well, but the reality is once interest rates go up, the loan rates are going to fluctuate from there. So I guess what I would say is be careful you're looking at when you look at a life illustration, you're looking at the value, the cash value accumulated within the contract, as well as the loan provisions to get it out. Because with this kind of newfound ability to get loans in the third-party marketplace, some of the loan provisions inside the life insurance contract aren't as important as they may have been when that was the only source of being able to get your money out. So that's my thoughts on that piece.
Yeah, well said, Rick. And we have a model here that shows a pay to 65 product on a 43-year-old, able to go out and secure a 90% loan to value right away. Go and service that debt in column 10 and deploy into alternative investment. I learned this concept. Obviously, this concept has been around a long time, right? The be your own banker. This is a little bit of a different version of it, without putting so much stress on the policy, like the Nelson Nash concept of be your own banker. I learned this concept about 10 years ago, where I met a kosher chicken farmer who was quite literally sitting on $17 million of cash and had this enormous real estate portfolio. And we were asking, the agent brought me in to show a couple different concepts. And he just had this affinity towards cash. He said, look, if I want to buy a shopping mall, I close in 21 days, right? I'm buying things at distressed values and I'm generating better returns. So, teaching him the concept of repositioning that cash to cash value life insurance with high early values really made a lot of sense, and then opened up the lending facility where his bank actually gave him lending at 1.7%. And this is like 6 or 7 years ago. It's a pretty remarkable concept where you utilize the whole life contract as your foundational planning tool and then go out and create alternative wealth using this strategy. All right, as we move on here, Rick, trust planning, right? There's one emoji here that broke out into tears, right? Really sad about the newly released Green Book, the Sanders bill, the 499.5% Act, and Von Holland's bill in conjunction with Elizabeth Warren and Cory Booker and others. what's called the step back. Yet there's another emoji here that's almost salivating at the opportunity to jump in and take advantage of the current law today, in the event that it may get changed going forward, using the quote unquote date of enactment type rules. So on that list is, in addition to a decrease in lifetime exemption, in addition to a potential loss of step up in basis, in addition to a cap gain rate that increased from 20 to 39%. There's also language about disallowing grantor trust use and taxing the transfer of assets through grantor trust immediately, or potentially losing the benefits of using grantor trust completely. There's also language that looks to address dynastic type planning, capping the dynastic language to 50 years and possibly less. So, Rick, as we explore the opportunities, we can sit and debate what will or will not happen, or we can go out and teach clients about grantor trust and the benefit of grantor trust today, and provide them. And why I included this into the whole life presentation is that the cash value in the whole life plans provide an escape hatch or provide flexibility in the event that the law works for or against your plan, right? It gives you the flexibility to move in and out of these products, unlike a GUL or a lien funded UL would. So, another reason that whole life has become popular. And just the concept of grantor trust, before I turn this over to Rick, I mean, it's very simple. Like, are you picking up the tab? Like, you're at lunch and you're with your friend and the check comes and it becomes, are you picking up the tab or am I picking up the tab, right? And it's the same concept here. In the non-grantor trust, any gifts made to trust, the trust is picking up the tax bill, right? So you obviously cannot create the amount of compounding growth if you're constantly getting, Rick used the term burn by the tax, right? It's the burn on the trust is the tax owed, versus the right side of this particular slide in the grantor trust. You're able to capture the full growth of the 6% assumption here. And you see by year 50, the difference in generational wealth between 78 million and 184 million. Now, that's not a freebie, because in the grantor situation, the grantor is paying the tax bill from their personal funds, which in today's planning world isn't necessarily a bad thing. But you can see this, how we use this as a tool to create and compound generational wealth outside of the taxable estate. So, Rick, I just want to give some commentary around the use of grantor trust and dynastic language.
Yeah, I think you covered most of it, Anthony, but I think one thing I would mention is you look at your non-grantor trust scenario, there's $180,000 of taxes due in that scenario. So that $180,000, if it's picked up by the grantor, is a tax-free gift to the trust. So you're talking about $180,000 of basically tax-free gift of the interest of the income taxes being due. So that does help from a planning perspective. But I think what's interesting is these trusts create so much opportunity because these trusts tend to have other assets in them. If I think back 15, 20 years ago, when I look at most life insurance trusts were naked trusts. That's the only thing they had was a life insurance policy in them. And nowadays what we're seeing are trusts that have a whole myriad of different assets in them, because people and planners in the estate planning community recognize the benefit of having these types of trusts out there from a planning perspective. So we're seeing these trusts that create lots of opportunity. But one thing I would say, I mean, you mentioned a couple different acts that are out there. I think we run the risk of having a little bit of this deer in the headlights approach with some of this stuff. And I think it's from the advisors as well as clients in this piece. And so I think the model really, if we're going to be successful in the marketplace, talking about these techniques, is making sure there's enough flexibility built into all these different techniques so that they can change if the laws change. So the classic example is a spousal access trust, where you would say, okay, I'm gonna create a trust. Rick Blazer creates his trust. My wife Kelly is a beneficiary along with my kids. Well, if everything goes crazy and that trust no longer works, the trustee can just distribute that policy back out to my wife, and I'm right back where I started. Okay, and therefore I've created that escape hatch to protect myself. I think the most important thing we can do right now is just create trusts that have the amount of flexibility in them necessary to adapt, because things probably will change, but we just don't know what direction they're going to change in at this point in time. And what I'm concerned about is if clients think they have to lock something and lock and load it right now, they're going to get concerned and say, you know what, let's wait and see what happens. And something may never happen, right? We don't know if anything's going to happen.
Well said. Rick, moving on to face number 7, and there's this is our second to last face and discussion point. It's a little mischievous, little devilish in the top right here in this emoji, in that there's some. This is a concept for a client who has a little bit of an edge, right? Who understands leverage, who is not afraid of borrowing. I've typically shied from premium finance as a personal preference over the years, because I've seen so many egregious designs come across my desk, and I didn't think consumers fully understood the risk, and that they were signing their name to a potential $100 million loan, right, in 20, 25, 30 years from now. And I see a lot of accruing and bonus multipliers and participating loans, and quite honestly, I just didn't think it was necessary in a lot of situations, because at the end of the day, if you're truly servicing the full interest payment, I don't know how much leverage you actually get. However, I've seen the light over the last 24 months, and for a couple reasons. Assets have appreciated significantly over the last 10 to 12 years, right? So in order to deploy or make gifts of dollars that are intended to use for premium, going to have to liquidate those appreciated assets and potentially trigger a tax liability, right? So that's number one. Number two, I'm seeing the lowest cost of borrowing that I've ever seen. So why would an astute investor who understands leverage trigger a tax liability, lose the opportunity cost on maintaining the compounding effect of that asset growth in lieu of going out and securing a 1.5, 1.8% bank loan to fund their life insurance, right? And as we study the IUL products that have lower charges, you can't design multipliers anymore, that have volatility control, that becomes appealing. But what also becomes extremely appealing is the whole life. And if you're using whole life in conjunction with other gifting strategies or other planning tools like installment sales, like grats, like the liquidation of business, and there is some credence, there is justifiable reasons to look at whole life as the product solution, or a portion of the portfolio as whole life as a product solution in the world of premium finance. So Rick, I know you're seeing a lot of it of late. You want to provide some commentary on your belief of premium finance, some of the benefits of it in New York Life's position?
Yeah, so I think that I'm fortunate enough, I guess, to be in the high net worth space where we're dealing with a lot of high net worth individuals. And what I'm seeing out there, quite frankly, is it just doesn't make sense for them to pay premiums once they get to a certain level, because the opportunity cost is too great in this environment right now for the money. So if you had a client that's sitting there with a whole bunch of municipal bonds that are earning nothing or a bunch of cash, they should just go ahead and pay the premium. But most people that are worth 20, 30, 40, $50 million or more, they didn't get there by earning 0% of their money. So they have some way of earning a significant amount of return on their money, whether it's reinvesting in their business or what have you. And so there's a real need for clients to be able to say, you know what, I'm not going to take $1 million out of my assets when I can get $1 million from the bank at 1.5. It just doesn't make economic sense for high net worth individuals to pay those premiums. So we're seeing a lot of that. And I think they like the security of the whole life contract. Because if you look at, let's say, a 10-pay whole life, when you get out to year 10, the cash value roughly on a current basis equals the premiums paid, somewhere around year 9 and 10 on a current basis, and maybe a little earlier depending on how you structure it. But you're looking at a situation where the clients know they have 10 years of interest rate risk on there. And then at that point in time, starting year 10, if they want to get out of the loan, they could theoretically cancel the insurance policy, take the surrender of the policy, and pay off the loan if they wanted to. That's not what we want them to do, but they know they could do that. So it's in the back of their mind, that safety latch that we talked about on the prior slide, where clients know they can get out. And when you look at the performance in let's say a 10-pay whole life product, when the premiums are done being paid, the illustrative performance right now is somewhere around, give or take, 5% year-over-year returns. And if you're borrowing at, let's say, 1.5 or 2.5% today, there's clearly some arbitrage that can be achieved there if rates stay about the same. Now, what I think is interesting, people always say, well, we got to run, the interest rates are going to increase. Okay. But because the whole product is so correlated to bond rates, which are correlated to interest rates, theoretically, over time, I believe that the dividends will track the loan rates on these general loan rates in the marketplace. So when you look at, and I'm not naive enough to think it'll happen overnight. There's going to be a lag. It could be 3 years or whatever it's going to be. But in a macro level, the interest rates will track the dividend rates in these products because the investments are so correlated. And what I guess what I'm saying is, when I look at high net worth people being able to borrow premiums, they're borrowing at a rate that's lower than what the general market can borrow at. And what they're effectively arbitraging is their great quality rating versus what the general market rates are for interest rate in the environment. I know for myself, if I go to the bank, they're not going to give me a rate of 1.5%, but I see 1.5% or 1.75% all the time from different banks. And so if you can get that type of beneficial loan rates, what's not to think you're going to get those beneficial rates 10 years from now? And so when you look at the performance, the life insurance policy becomes a real asset. And just like a piece of real estate, the longer you hold the policy, the more equity you build in that policy. And think of real estate investors, they want to buy a piece of real estate today. The equity may be small because they're leveraging the asset. So they're buying at, let's say, 90% leverage on a piece of real estate, and they got 10% equity to start. In a life insurance policy, they're looking at starting, once the premiums are paid, they're building equity in that policy just like they would a piece of real estate. And that's kind of how they correlate these pieces together. So we're seeing tons and tons of it. And I think that the whole life makes sense because of the correlation of the rates, as well as the security of knowing what the cash values are going to be in that product down the road, versus other types of products where there could end up being a lot less cash, and then the client's on the hook for the paying off the loan out of pocket, starting after, let's say, year 10, 11, or whatever down the road.
Well said, Rick. And a little spin on the commercial financing, where the emoji in face number 8 is a little queasy, right? Maybe the commercial financing with partial accrual just doesn't meet the risk tolerance of a particular consumer. There has been a huge movement towards private loans, or what we call private financing, where clients control all of the variables, right? In conjunction with an AFR, long-term AFR loan, which you can lock in if the present value of all premiums or present value of the entire program are met in the current year, with guaranteed product. And whole life actually fits really well, particularly in the survivorship chassis. Rick, you want to talk about the opportunities in private financing, and the liquidity or the escape hatch features in the private finance strategy?
Yeah, I mean, similar to the premium financing, we talk about private financing, the risk is always in the interest rates, right? So anytime you're talking about borrowing, the question comes up with the interest rates. Well, what's interesting right now is the long-term AFR rate, which you can lock in today, the applicable federal rate for interfamily loans, is 2.07% in July. And what's kind of cool, and this is a little bit of a sales idea, I guess, when you look at like a New York Life product in particular, we have a premium deposit account that we can lock in at 2.5%. Okay. And we have, as we talked about earlier, we have a product that's based off what's called a 4% underlying guarantee. And we're looking at a situation where what you can do, and we see this being done quite often, particularly in the business split dollar marketplace, where someone's going to lend all the money for the premiums up front in year 1. So I'm going to take all 10 premium payments. I'm going to lend that to a trust, or if it's a corporation or a nonprofit, I'm going to lend it to an individual in year 1. So I got all the money up front. I can lock in the premium deposit account at 2.5%. And more importantly, I can lock in the AFR rate at 2.07%. And you can actually accrue the 2.7% AFR rate inside that policy. And depending on how much premium we put in, if we're looking at a supplemental retirement situation, or a situation where we need a certain amount of death benefit, we can actually let that 2.07% accrue inside the contract forever. Because remember, we're locking that in today forever, that 2.07%. And as long as the policy exceeds that 2.07%, we're transferring wealth without any payments, let's say, by the person who's borrowing the money. So this is a situation we see quite a bit. So if it's a trust that's borrowing the money, the trust can borrow the money from the grantor, can arbitrage or can lock in the 2.07%, let that rate just arbitrage forever if they want. And then the net amount of death benefit over and above the accumulated loan interest will be paid to the trust as a death benefit for estate planning purposes. Or if it's a corporation, or we see this quite often in the nonprofit space, they're going to lend the money to the executive. The executive is going to accrue that interest inside the policy, take income during retirement, and then once the income is done, the death benefit will still be enough to pay off the loan back to the lender. So it's really creating, it's this low interest rate environment that creates these unbelievable opportunities. And you talked about earlier, this 4 to 5 month run. I don't know how long these interest rates are going to remain low like this, but I know we have a really strong product right now with a low interest rate environment right now. And so when you look at all the things we talked about today, whether it's navigating the uncertainty in the tax planning, the ability to lock in all these rates and create an unbelievable financial tool is pretty exciting. And we're seeing just a tremendous amount of that being done in the marketplace.
Yeah, well said, Rick. And one of the attendees points out that you don't have to lock in at the long-term rate of 2.07. The shorter-term rates are some of midterm, actually short-term, midterm 3 to 9 is about 1% right now. So if you can arbitrage that 1%, it's an interesting play. Just a little spin on that. We just talked about private loans, assuming the grantor was making the loan. But don't sleep on your C Corp clients who can arbitrage a lower corporate tax rate than their personal tax rate, where they don't actually have to take the after-tax proceeds and make a loan. You get a little bit of an arbitrage when C Corp is actually the lenders. It's just a little twist on that. Rick, we're just about out of time. I've been able to answer several of the questions from, actually all of the questions from the participants who have typed in the question and answer. So I don't think we need a Q&A session. So, at this time, I just want to thank everyone for listening in. A recording will be dispersed within a couple hours of the time we wrap up here. Hopefully these ideas can spark some interest in your existing book of business. You can share them with your centers of influence and prospects, and you give Life Brokerage and New York Life an opportunity to design for you. So, again, we want to thank you for your participation, and enjoy the rest of the week, and have a terrific weekend. Rick, thanks again for co-presenting.
Thank you. We appreciate it.